Many people face difficulties in investing. I got to know that a lot of people even fear investing their money, so they keep their funds at home, and later on, inflation eats them up. A large number of people face huge losses and end their investing careers. Actually, investing has some rules. Even millionaires follow them to earn returns from their investments. In this video, we will be revealing the 10 rules of investing that will make you rich very quickly. Now let's start. 1. Establish a financial strategy for investing that is in line with your objectives. A strategy for your investments that is in line with your financial objectives should be made before you begin. Even while each person has unique objectives, many of them frequently overlap in some way. Saving for a house and retirement, for instance, are typical long-term objectives. You may determine how aggressively you'd want to invest once you've determined what you want to accomplish and the age at which you'd like to do so. The absolute least that should be put into investments is 10% of pre-tax income, and 20% is his typical recommendation. That number might go as high as 30% to 40% if you want to be more aggressive with your investment approach. 2. Don't attempt to time the market. The Consumer Price Index and Federal Reserve meetings are only two examples of the numerous factors that affect how frequently the stock market rises and falls. As a result, attempting to time the market is never a wise idea. Don't worry about headlines that are negative about the economy or markets. Instead, focus on your biggest asset when investing: time. 3. Diversification is important. The act of diversification involves spreading your funds over a variety of asset types. By doing this, you're attempting to invest in securities with a range of risks from low to high in order to reduce the likelihood of suffering losses. One of the simplest ways to diversify your assets is to buy shares in an index that represents the 500 companies that make up your portfolio, such as the S&P 500. Imagine there is a scandal involving a certain CEO of one of those 500 companies. Although the company's stock will definitely fall, you won't really feel the impact because you also own shares in 499 other companies. If you want to know more rules of investing, then do subscribe our channel and also press the like button. 4. Cover losses with insurance. Similar to diversification, you want to think about investing with some form of insurance against any losses. According to millionaires, the simple act of diversification is basically a hedge for the majority of individuals. You are thereby hedging one business with another. The best stock hedges are still cash, savings accounts, and bonds. A hedge is an investment that aids in reducing your financial risk. A hedge works by keeping an investment that will go the opposite way from your main investment, so that if the main investment decreases, the investment hedge will counteract or reduce the overall loss. 5. Reduce expensive taxes and investment costs. Investing in risky assets and paying excessive taxes should be avoided. Taxes are where we'll start. Taxes on capital gains or capital gains taxes are typically due when selling investments for a profit. Using your losses to balance your profits can help you to keep your capital gains to a minimum. Consider a scenario in which you sold two stocks in the same year, one for a $5,000 profit and the other for a $2,000 loss. Utilizing this strategy, commonly referred to as tax loss harvesting, will result in taxation of the difference, which in this instance is $3,000 plus interest. When you do a transaction, such as buying a stock or mutual fund, you'll also probably encounter transaction costs. By reducing the number of transactions you make or grouping them together, you may reduce transaction costs to the absolute minimum. 6. Be aware of the investments you are making. Even while it's essential that you comprehend the investments you make, you don't necessarily need to be a financial expert. Rather than relying solely on the recommendations of influencers on TikTok, you should take the time to do your own research before making any investments. In other words, you should be aware that if you invest in the S&P 500, you are doing so in 500 of the biggest corporations in the country that are listed on stock markets. But you might think about seeing a financial counselor if you're having trouble understanding the investments you're making. 7. Gradually increase the amount you invest. When investing, time is your most valuable resource. Increasing your investment over time plays to this. Time is crucial when investing, as I've stated, thus it's generally recommended to start doing so as soon as feasible. We all have costs, such as rent or vehicle payments, therefore we can't invest the majority of our money, according to reality. Nevertheless, investing over time enables you to cover those costs and perhaps have some fun while continuing to make preparations for the future. Several investing tactics may be effective in this situation. For instance, dollar cost averaging entails making regular, equal amount investments regardless of the performance of the stock. Another is investing in lump sums, which, in contrast to the first, entails investing a portion of your money all at once. Both have advantages and disadvantages. For instance, using dollar cost averaging would probably result in higher transaction costs. The impact of market volatility on your assets can be reduced by dollar cost averaging at the same time. 8. Continually evaluate your portfolio. At a bare minimum, you should assess your portfolio once a year if you don't deal with a financial counselor. According to millionaires, the ideal situation would be for you to work with a financial advisor, someone like himself who does this on a daily basis and can assess the market and decide what to invest in. 9. Hold your investments for a long time. Holding an investment for a long period is crucial to creating wealth and making more money, much like adding to your investment over time. Years are needed for your money to develop, and over time it will be able to increase exponentially and yield greater profits. Money that you know you'll need in 2 years shouldn't even be on the market. Not to add, there are losses that have not yet been realized. In essence, until you withdraw from the stock market, if you have money invested there and you notice that your investments have decreased, it is not a true loss. 10. Get started with investing as soon as you can. Starting as soon as possible is one of the most crucial investment criteria. This is due to the fact that it takes time for your invested funds to increase. Another benefit of starting early is the ability to invest more aggressively, which may include choosing riskier stocks or assets with larger potential returns. This is possible since you have more time to recover and reach your financial objectives and may also have less costs that make it easier to save. Whatever path you select while investing, time remains the most crucial element. That's all for today. Now you know all the rules of investing. Always invest your money carefully. Investing can earn enormous profits. Share this video with all of your friends and family members and also with your colleagues. Hit the subscribe button and also press the like button. This small activity motivates us to make more amazing videos. Comment below if you are having any queries in mind. Thank you for watching this video till here.